In this episode, we speak with Michael Henriques, partner and senior portfolio manager at Magnetar, a multi-strategy alternative investment manager with more than $22 billion in AUM. Founded in 2005, the firm invests across public and private markets in the US and Europe, with a focus on alternative credit, fixed income, and venture strategies. Its alternative credit and fixed income business targets specialty finance, structured solutions, and opportunistic markets, seeking to generate attractive risk-adjusted returns, particularly during periods of market dislocation. Michael brings 3 decades of experience in fixed income, structured securities, and real estate. He joined the firm in 2007 and previously served as a managing director at Deutsche Bank. Before that, he spent more than 10 years at Goldman Sachs, where he began as a structured finance analyst and ultimately co-headed the CDO and Synthetic ABS group. Michael received his MBA from Wharton and a BA from Princeton. Magnetar was recently recognized as a top private credit firm of 2025 by GrowthCap. I'm your host, RJ Lumba. We hope you enjoy the show. If you like the episode, click to follow.
RJ Lumba is the managing partner of GrowthCap and the executive chairman of Market Insight Media. He is the host of Growth Investor, a podcast featuring today's best investors, executives, and founders. In the minutes ahead, we'll uncover insights and strategies for accelerating growth and succeeding in business.
Mike, thanks so much for taking the time. Great to be with you.
Great. Thanks for giving me the opportunity.
I remember Magnetar quite well in their firm's earlier years. Well, I guess this was while I was back at Lazard and Merrill Lynch, and we were thinking of kind of investors that might be interested in some of our more opportunistic deals. Relatively speaking, the firm is still somewhat young. You know, it was founded in 2005. Obviously, it's grown tremendously. It's doing a lot. But maybe to kick off, you can tell us a little bit about Magnetar, why it was founded and kind of its evolution over the last 20 or so years.
Yeah, that'd be great. Thanks for sort of helping me with the introduction and the year founded. So it was 2005, founded by Alec Ludowitz and Ross Lazar, shortly thereafter joined by Dave Steinerman, and those were the 3 managing partners for almost the entire life of the firm thus far. It was initially a multi-strategy fund, which really started with Alec's background, which was equity, event-driven, and risk arb. But with Dave coming on, it sort of broadened into fixed income. And today, the firm has 3 core strategies: alternative credit fixed income, which I'll refer to as ACFI, quantitative equity investing, and venture investing. So I'm one of the 3 co-heads of the alternative credit business, and that is about 85% of the firm's capital. So over time, that actually grew to be the majority of the firm's capital. And the equity business really became increasingly quantitative. So it's kind of had some pretty significant evolution over those years. So ACFI focuses on asset-based investing. And as I'm sure we'll talk here as we go through examples, we're pretty flexible on structure, we're pretty flexible on the sector, but there's always an asset-based theme. There's always something underneath that generates income, which we're really working to figure out the right structure and the right way to work with our partners. Yeah, so I think that's the high level.
That's great. And that leads us into what you alluded to, the sectors. You can invest across sectors. Everything has an asset-based theme. And as I was looking through some of these areas that you touch, it's specialty finance, auto, film, AI infrastructure, a lot of interesting developments, particularly in AI infrastructure. Maybe that's an area we could spend some time on. Is that an area you look at in particular?
Well, to some extent, the whole team is involved in a lot of things. I think what's unique about AI infrastructure, and these days, if you Google Magnetar's name, you're going to pretty quickly see our historical relationship with CoreWeave as well. And that really sort of gave us a bit of an entry into that space. But I think what was unique about CoreWeave and a lot of the AI infrastructure is these are really capital intensive tech businesses. And that's different than traditional tech businesses, oversimplifying, but for example, software, where you put a lot of money in up front on programmers and salespeople, but once you get traction, you don't really have that much ongoing cost and you have a very high marginal profit. AI infrastructure, on the other hand, with every new contract, you have to buy GPUs. You have to actually have physical space. You have to pay for energy. So there are very significant ongoing costs associated with it. And that's kind of interesting because it falls, I'll say, a little bit between the cracks of traditional private equity and bank lending. Because for private equity, the ongoing capital needs are difficult. That's just not the typical private equity model. But these companies are often still not generating income, net income. And that makes it hard for traditional bank lenders. So there's a lot of room to provide capital in a kind of creative way. And it's not just AI infrastructure. I think you can also make the same analogy for robotics. You can make the same analogy for driverless cars. We're in a generation where a lot of these new tech businesses are very capital intensive, throughout their lifespans.
Hmm. And thinking about the book that you work on or your team works on, what's the split roughly between public and private?
It's substantially all private. We still do invest in securities, but that's less than 10% of our portfolio. It was quite a lot more 15, 20 years ago. I joined the firm 19 years ago. And while we have invested in some debt facilities of public companies, I'm comfortable saying it's more than 80% private.
Hmm.
I'll qualify because our position in CoreWeave that still exists is public to the market. That's public. But when I think of it from an invested capital perspective, certainly over 80% is private.
Does your relationship with companies, is it direct relationships with companies? Or, in some cases, when there's investors or asset managers, their involvement is facilitated in another manner, or there's, a go-between fund. Curious if you're working directly with these companies.
Well, we'll talk to anybody, but mostly directly.
Okay.
The sourcing, it's not so much from the big banks. It tends to be sometimes from very regional dealers, groups that don't have capital and might be making the connection. But then our ongoing involvement is very much directly with the companies. And it's really kind of a function of a couple of pieces. Often our initial structures, we really want to understand the partner's needs, right? Like any good deal, you've got to balance your needs with your partner's needs and try to find a structure which is aligned. So that's going to be a lot of direct dialogue, a lot of real, working together. And, fortunately, we have, a reasonably flexible mandate that allows us to be flexible on structure. And then on an ongoing basis, a lot of our investments, even though they're asset-based, will have an equity aspect to it, which might be warrants that came with the asset investment or some convertibility feature. And we'll participate with companies over time in additional funding rounds. So we really try to be partners with the company, and we want them to think of us as partners helping with their growth, not just when we compare it to like a traditional lender where the companies don't talk to the lender unless there's a problem. We really want to be having ongoing dialogue over how their business grows, and we want to help them win, but we want to participate in those wins too.
Mm-hmm. So these are instances where a management team is really trying to figure out how to optimize their next capital infusion. And they could go potentially private equity. They could go more traditional private credit. But then you could come in here and say, well, listen, let's think about this. How can we be creative and suit your needs and be a good partner for the medium to long term? I don't want to put words in your mouth, but I'm trying to kind of just conceptualize how this works with a management team.
Yeah, no, I think that's absolutely right. Do you mind if I use a couple of examples?
That'd be great.
Well, let's start with the biggest one is CoreWeave. So we initially got to know CoreWeave when they were really trying to provide remote compute for crypto miners. But over time, as we got to know the company better and their business evolved to be facing some of the most creditworthy companies in the world, we really came to understand that their capital needs were driven by specific contracts, which were going to be very profitable, but most importantly, which were very distinctly bankable, separate from, a private equity need. So we did a lot of things with CoreWeave over time. We led their Series B round along with NVIDIA. We also invested in their $2 billion and $7 billion debt facilities when they were still private. And I think the fact that they were able to raise that much capital in a non-dilutive fashion really kind of unique and created tremendous value for the equity owners, of which we were a significant one.
Are there instances now in the private markets where like a company should know about you? They may not be aware that, Magnetar could be a great partner for them, but they're simply doing their initial review of capital providers under more traditional kind of lenses.
I'm sure there are companies that don't know about us, and hopefully over time they will. I don't think they necessarily think of us in their traditional scope of capital because our capital is more flexible by nature, right? So if they think they need straight equity or straight debt, that's actually not what we typically do. We're doing a lot of hybrid instruments, which were very customized. And, if we do our job well in certain sectors, we get to know multiple counterparties and we do become known. So to give you a couple examples, obviously Corey is very public, but we've done GPU financings with multiple counterparties using different types of chips, with different types of horizons. And to some extent, that's kind of what we think one of our value adds too, because we're collecting data from various partners. We like to think it makes us more knowledgeable and we have more involvement in the overall ecosystem. So I think that allows us to be more flexible, but also hopefully to understand their businesses better. And then to give you just an example at the other end from GPUs, fix and flip lending, which has become a big business in the US, we've worked with over 20 different lenders over the course of the last several years in different capacities. We've bought loans, we've been equity investors, we've invested in securities, but we collect data from all of them. And we sort of can understand where they fit into that ecosystem. I think it makes us a better partner for them. So ideally, I think within the ecosystems we're heavily involved, I do think people know us quite well. But as we look at other ones, sometimes we have to work a little harder to find them.
Mm-hmm. And those ones you're referring to, does that include auto and film and specialty finance?
It does. It does. I mean, especially finance has become very broad, right? And it's funny because, of course, ABF for asset-based finance is something that sort of is in vogue right now. And investors talk about it like it's something new. It isn't. It tracks back at least to the Great Depression with the creation of Fannie Mae, which was really a way to help banks diversify their balance sheets by selling assets and taking back things that were less correlated, which was basically structured finance. And we've been in the business for about 20 years. It was very deliberate following the financial crisis. I guess I should say 18 years following the financial crisis, because we really saw banks pulling back. We saw that the markets were becoming less functional around some of these more asset-based businesses. But we've had to evolve over time, right? I mean, if you think back to, the years after the financial crisis, it was largely about buying securities that had been downgraded but had good risk returns that insurance companies and banks couldn't own. Then as banks came back into the market, it was about, providing mezzanine capital in some form because they were coming back, but they were still taking a more cautious view. And over time, we wanted to get closer and closer to the assets. So, if you look at our business broadly today, we purchase assets, which can range from music royalties and real estate loans on agriculture. We do participate in debt facilities of both public and private companies along with other investors. And we'll also invest in various types of hybrid securities to really align both the equity and the debt interest with them. But there's a lot of sectors. It's a lot broader than it was certainly 10 years ago and certainly more than 20 years ago.
To what extent do you become involved with the companies in providing any strategic insight or operational insight? Or is your involvement more so on the front end, as you get involved with the company and provide the capital on a structured basis?
Again, if it's okay, I'll give you a couple of examples.
That'd be great.
We already touched on CoreWeave, so I won't keep on that one. In-kind. In-kind is a restaurant finance business. Restaurants are a hard business. They have a lot of variability. They have a high fail rate. And what in-kind does is they buy future food and beverage credits for some discount today. And then you and I as consumers can basically pay for our bills through the in-kind app, and we get a portion of that discount. So that's a core business. We were the first, as far as we know, to finance those types of receivables. And over the last 5 years, their revenue has grown 30-fold. So they've done really well because they're offering a solution in a sector that doesn't have a whole lot of variabilities. This is the example. I actually asked Johan, who's the CEO, if I could use their name on this podcast. And his line, which is a great line, was they talk to us every day. They talk to us about their data. They talk to us about their strategy. And that's distinct from lenders only talk when there's a problem. So even though our initial investment was really in the receivables, we got some warrants for that, which aligned us on the equity side. Over time, we participated in subsequent rounds. But we also have a strong data science business here at Magnetar. And you actually pay through their apps so they know what you ate, where you ate, how much money you spent. And there's a lot of value both in analyzing the credit risk of the restaurants that they're financing, as well as thinking about their growth areas. So we work very closely on the data side. In addition, one of my partners here previously was the CEO of a large financial services company. He's on their board. He works closely with them on strategy and operations. So we actually provide a lot of ongoing, interaction. And I guess just one other variation on that, there's a company called Contera, which is an agriculture finance, real estate finance business. And they really started in a joint partnership with a government entity that wanted to facilitate rural finance. But we met them, and initially our business was buying loans, which we had to approve that they had underwritten, which were often transitional and didn't fit other lenders. Think about a farm that's going organic and has to lie fallow for a year, so it's going to fail any debt service coverage test. It's not eligible for that. So we chose which loans we chose to purchase from them. But as we got to know the business, we got to know their markets, we got to know their processes, they needed some growth capital. So we provided some convertible preferred, which ultimately made us a minority equity owner when we converted into them. And we also helped them finance new business expansions because we had comfort with the team, we had comfort with the data, with their processes. So we really helped them grow the business because we were on the inside, we're a partner And if it isn't clear by this time, the majority of our transactions are repeat transactions with existing customers. And that's probably the best validation that hopefully the CEOs think we're valuable ongoing partners.
Mm-hmm. Curious on that kind of growth capital scenario. Do you ever do anything that's just almost straight down the fairway, growth capital to a tech company, be it a software company, an AI company, or is that just not that interesting to you? You don't want to spend time competing in this area where there's like 20 other investors.
Never say never in this business. I'm very much there's no bad bonds, just bad prices type person.
Mm-hmm.
But I think it's a very target-rich environment right now. And fundamentally, we want to get involved with partners who have large TAMs. Ideally, they're in, segmented markets. They're generating assets that are a little bit trickier to finance. And we really want to help them grow their business, and we want to participate with them. So I think in the current market, participating in a straight facility is a little bit less likely for us.
Mm-hmm.
If you look over the last 15 years, it was a less target-rich environment, or, so some of those deals are just easy to participate in some of those facilities. But I think today we're really focused on more value-add opportunities because we think the nature of our capital allows us to do that. And we think there's a really big need.
Switching gears for a second, tell us a little bit about yourself. Where are you from?
So I grew up in Bayonne, New Jersey, and have lived within 50 miles of New York City since I was 6 years old. And I don't know what a traditional path is to this career, but when I think of mine, I certainly didn't know what an investment bank was until I was interviewing for jobs when I was in college.
Mm-hmm.
I'm sure most people who interviewed me would have told you also I still didn't know what it was. But I was kind of in the right place at the right time, which I'm sure is a theme with a lot of people you interview. I joined Goldman in 1992, which was the very early innings of structured finance.
Mm-hmm.
I wasn't a great analyst. And, you remember the typical path then was 2 years and you go to business school, unless you were really exceptional. And my wife, who also worked at Goldman as an analyst, would happily tell you I wasn't so exceptional. But I had personal stuff going on. Namely, my mother was undergoing cancer treatment, and I wanted to stay in New York and not go to business school. And the department was run by Mike Mortower at the time, who some of your listeners may know from Liar's Poker fame.
Mm-hmm.
And Mike was very much about personal relationships. And even though he didn't have a whole lot of interaction with me, he basically pulled me aside and said, we'll find something for you to do to stay in New York for the next year. And I ended up joining a spinoff of the mortgage department which at the time was called the Principal Investments Group. And I was the analyst in a group of 4. That's the group that became Goldman's SSG business, special situations. So I got to spend my next several years seeing that expand massively and really become, I'd say, one of the most creative and flexible risk-taking functions on Wall Street. So totally right place, right time. And unquestionably the most formative part of my career.
Amazing. I noticed you did your undergrad at Princeton. I live in Princeton, so I always kind of mention it. There's a lot of Princeton folk around here. What's one thing you could say about your experience in college that maybe prepared you for your career?
That's a great question. So I grew up in Bayonne, New Jersey. So if you know Bayonne, it's just outside New York. It's a blue-collar town. And, my parents were educated, but no finance background. And I went to a public school, which had about 25% who went to college. So I think the thing about Princeton was, meeting other kids who had real dreams, who had real ambitions, and they had a much better sense of what that looked like than I did at the time. But I think that's the really important thing. And, when I think about my kids in college, I don't think they realize, it's a little bit about what you learned, but it's kind of more about your peers and understanding their ambitions, what really matters. And I think that really moved me to a very different level of, I don't want to say ambition, but a sense of what I could contribute, how I could sort of succeed. And so I think it was really about the other people around me who really helped create a drive and made me realize other people really had thought about this and felt like they could have an impact on the world, which is not the environment in which I really grew up.
We're entering the tail end of the conversation. I have 2 final questions. One is, can you tell us about a person who has had a profound influence on you?
Sure. I'll stick on the business side for that. So going back to the Goldman Principal Group, I said I was the analyst in a group of 4. Pete Brigger was one of the 2 VPs in that group. So this was before his partner, before he obviously was one of the magic partners of Fortress. And the thing about SSG that was special at the time was Goldman wasn't a bank. It was a very flexible environment to figure out what was the right risk return profile for any given investment. And while many people who listen to your podcast probably know Pete as a great investor, appropriately, what I really took from him was how he asked questions, how he listened to what our counterparts were looking for. Because even though we're on the other side of the table, ultimately we're looking to buy assets from them. Often these were regional banks who might have needed to sell assets to improve their capital ratios, or finance companies involved in a merger where a non-core business had to be sold. And often they didn't know all the tools, they didn't know all the options. So even though we were really a counterparty, there was an advisory element to it of trying to explain the different options to them. And, you really have to listen to what they care about. And, to use a term I think I learned in business school in my negotiation class, you have to listen to their interests, not what they actually say, to really understand what they're trying to achieve and offer them solutions they might not be aware of. And Pete was amazing at that, right? That was an incredible skill, which hopefully I still carry today. And that also extended to how he ran the group. I mean, he worked us hard, and he's very hardworking. He worked the rest of us hard, but he also understood what we needed, and he understood what we valued. And it created a strong work ethic. It created a lot of loyalty. And yeah, so I'll say Pete Brigger.
Last question. Can you tell us about a charity, cause, or other endeavor that you're passionate about?
So, the firm, Magnetar supports and encourages employees to be interested in various things that obviously have personal significance to them. And personally, my younger brother is autistic and lives in a group home, so I certainly spend a lot of time focused on that. But I'm actually going to talk about one that the whole New York desk tends to participate in. There's a program called HEAT. It's run by Michael Henriques, who is the superintendent of the Brooklyn South Public Schools. And it really seeks to teach public school kids, high school kids, about important skills that are going to be important in their work, about literacy, about responsibility, about performance. And then at the end of that program, you get a year actually working with practitioners from different fields. Other sponsors include Microsoft, New York Life, Maimonides, and New York Langone and Health Systems. So, there's a broad array of programs. And for us, when we teach, obviously it's partly about financial literacy, but it's also about helping these kids learn about possible careers that they probably wouldn't encounter in their ordinary lives. And I think it's great for them. To be honest, it's also great for us because it kind of reminds us of how fortunate we've been. I'll call out one of my colleagues who was integral in getting us involved in that program, Hin King Tai. He and his wife were the two people involved in that. Hin came to the U.S. as a child with his family from another country without many assets. His family had a sneaker store in Queens, and he was the kid who went outside when it was raining and learned about market pricing based upon market factors and how hard it was raining. And, for me, even coming from Bayonne, my parents were educated, but certainly had no financial background. So I think it's important to remind us that we're fortunate, and to sort of bring it back full circle. We were in the right place at the right time. And there's an element of luck to that. There's an element of skill to it too. And I think we have to help these kids have the opportunity to potentially be in the right place at the right time to learn about other career paths they might be able to take.
Wonderful. And we'll certainly include a link to the charity HEAT when we post this. Mike, want to thank you again for taking the time. It's truly been a great conversation.
No, Arjun, it was a pleasure. Thank you very much.